Going through a divorce can be emotionally draining and financially challenging. Two significant financial aspects that come out of a divorce are alimony and child support payments. Understanding the tax implications around these payments is essential for both parties involved. I delve into the different aspects of Canadian tax laws governing alimony and child support payments and discuss how you can ensure that you're handling these payments in the most tax-effective manner. Alimony, also known as spousal support or maintenance, is a series of regular financial payments made by one spouse to another after their marriage or common law relationship has ended. It is typically awarded in cases where one spouse has been financially dependent on the other. In Canada, alimony payments have tax implications for both the payer and the recipient. For the payer, the payments are tax deductible. This means that they can reduce their taxable income, potentially lowering the amount of tax they need to pay. On the other hand, for the recipient, alimony payments are considered taxable income and must be reported on their tax return. It is essential to have a written agreement or court order to establish the alimony payments for tax purposes. The agreement must be clear that the payments are intended for support, and the recipient has the right to enforce the payments. You should also keep records of all payments made or received to avoid any issues with the Canada Revenue Agency, CRA. Child support payments are made by one parent to the other for the financial support of their dependent children following a separation or divorce. Unlike spousal support, child support payments have different tax implications in Canada. For child support payments established or changed after April 30, 1997, the payments are not tax deductible for the payer nor considered taxable income for the recipient. However, for child support orders or agreements made prior to May 1, 1997, the tax treatment is the same as spousal support payments, tax deductible for the payer and taxable for the recipient. If you have a pre-May 1, 1997 child support agreement, you can update it to follow the current tax rules by signing a written agreement with your former spouse. This agreement must state that you both agree not to claim a deduction and not to include the child support payment as income on your tax returns. Regardless of the type of support payments you are making or receiving, it's crucial to maintain detailed records to ensure you're correctly reporting the income or deductions on your tax returns. This includes keeping copies of your written agreement or court order, payment receipts, and bank statements showing proof of payments made or received. For payers, you must ensure that your social insurance number is included on payment receipts or documents. This way, your recipient will have the necessary information to report the payments on their tax return, preventing any potential disputes with the CRA. If you're in a situation where you're receiving both child support and spousal support, keep in mind that only spousal support needs to be reported as income on your tax return, while child support remains non-taxable. Dealing with tax implications surrounding alimony and child support payments can be complex, especially during an emotionally challenging time like a divorce. To ensure that you're properly reporting income and claiming deductions, it's wise to seek the guidance of a tax professional or family lawyer who can provide you with tailored advice based on your specific situation.